Hi, this is Danny Cadambay with Churchill Mortgage, and I want to take some time to talk to you today about why now is still the best time in the next 5 years to buy a house. There's a lot of stuff that's being said in the media, scary stuff. Interest rates are going to keep going up. Prices of houses are going down. Equity and home values are going down. It's very scary stuff. And if you were thinking about buying a house and you were listening to those newscasts or reading those articles in the news, you might get scared and you might think, hey, wait a minute, let me back off. Let me wait until things settle down. So what I want to talk to you about today is why you should not listen to what the media is saying about the housing market. It is a great time to buy, and I've got a presentation for you to explain to you why that is so that you can understand why it is still a really great time to invest in owning a home and why waiting could actually end up costing you even more money in the future. So let's have a look at it. All right. So first of all, why are mortgage rates rising? This is a chart published in September of 2022. So we see mortgage rates rise for the 6th consecutive week. So looking at the end of the chart over here, we've got August 25th until the end of September. So this chart was produced in the beginning of October. And you can see that rates are continuing to go up. So what's going on here? The aim of Fed tightening is to curtail demand in an effort to tame inflation. And when it comes to the housing market, the Fed's actions are working. Home sales, both new and existing, are falling. Builders have cut back production in response to rapidly declining affordability. And annual house price growth has slowed from the peak of nearly 21% in March of this year to 16.7% in July. So what we're seeing happen here is that inflation is the reason why mortgage rates keep going up, and it's fears about inflation continuing in the future that is continuing to drive those prices higher. But the Fed has been taking action to rein in inflation, and the latest numbers show that that action is actually working. Okay, will rates go higher? Will home prices drop? This is stuff that you're seeing in the media a lot, fears that these things are going to happen. Well, what do the facts look like? While mortgage rates are expected to continue to drift higher over the coming months, much of the rapid increase in rates is likely behind us. Nationally, while month-over-month house prices may decline, annual house price declines are not expected, given the ongoing supply-demand imbalance and continued strength in the labor market. This is Mark Fleming, the chief economist from First American. All right, let's look at another quote. When the economic uncertainty dust settles, those buyers and sellers who are on the sideline will jump back in the housing game. Demographic trends support elevated purchase demand in the years to come, so it's a question of when, not if, for the housing market. So, right now, because of what's been going on in the economy, we're starting to see signs that a recession is imminent. What do we know about recessions? We know that mortgage rates go down in recessions. Let's look at the history of this. So here we've got 2 recessions in the 80s and early 90s, and it's a little bit faded out, but you can see mortgage rates are starting up here and dropping down across the diagonal of this little yellow bar here. The same thing is happening in the mid-90s. We're seeing another recession here. We've got another one here in 2001. And then, of course, we've got the housing crisis, the great financial crisis of 08-09. Here, we're seeing something a little bit different. We're seeing mortgage rates kind of go up, and then they kind of go down, but this is kind of the exception. This was, and I'm going to show you in the next graph, we're going to see that this is the one time that things went a little bit weird. But then when we move forward to the pandemic, we experienced a recession then, and you can see the interest rates were dropping from 3 3/4 down to 2 3/4. What happens to home prices during recessions? Housing stays strong through recessions. So the white line here is going to be the housing index. This is going to be tracking the values of homes. And then the dark vertical lines are the recessions. So if we look historically, starting in the 60s, we see a continuous increase in the value of homes all the way up to its peak in the bubble of '08, entirely independent of whether or not the economy is recessing. Now, in '08 to '09, you'll see that home prices went down and we had a recession. As I mentioned, this is a unique situation. It is kind of a exception to the rule because in this case, it was the housing bubble that caused the recession. So I want to pause here and talk about a question that is floating around a lot amongst real estate agents and home buyers, people looking for homes. Is what's going on now a bubble? Is it the same as what happened in '08? And I don't have a lot of time to go into it on this talk. We'll talk about it more on a future video, but no, it's not. The reason why the economy is recessing right now has more to do with the supply chain interruptions and the general chaos that the pandemic caused to the global economy, and less to do with what's going on in the housing market. Whereas if we go back to '08, the housing market was in a bubble, and it was the bursting of that bubble that caused so many people to lose their homes and lose the wealth that they had stored in their homes that then led to the recession. So it's not quite the same. That's why we see in that one situation, house prices are going down, but in every other recession, home prices continue to grow. Now, why is that? The value of your home has a lot to do with demographics. This is about supply and demand. The supply of homes cannot grow as quickly as the demand for homes because it takes a long time to build a home, but people are moving, people are changing from working in person to working remotely, and the household size is actually decreasing. We're seeing more single families, more single individuals as compared to families. So this is causing an explosion in the demand for homes, and the supply simply can't keep up. And we're going to talk about that in a couple of slides. All right. What about moving forward? Over the next couple of years, are home prices going to continue to go up? Is the value of your home going to appreciate, or do we expect it to depreciate? Well, if we look at the chart that I have here, the number of MSAs, so that's a metropolitan service area, forecast for levels of price change is 618 MSAs are forecasted to appreciate, whereas only 257 MSAs are forecasted to depreciate. And of those 257, only 30 of these MSAs are forecasted to have depreciation greater than 3%. So on the whole, it is more likely that your home is going to continue appreciating than it is going to continue or to start to depreciate. And here in the Nashville, Middle Tennessee area, we're one of the lucky ones. We are forecasted to continue appreciating. All right, next I have a real estate report card for Davidson County, Tennessee. And I just want to draw, there's a lot of information going on this slide here, but I want to draw your attention to this area right in the middle where we're looking at appreciation. So historically in purple, we're going back as far as 63 years. We've got appreciation rates of 3.53%, 7.97%, 9.10% over the 63-year, 10-year, and 5-year period. Then when we look at the forecast in the dark blue over here, the 1-year anticipated appreciation for Davidson County is 2.09%. When we take that out to 5 years, the cumulative appreciations, that's not annually, that's the total over the spread of 5 years, is 18.72%. So that's almost a fifth of your home value over and again, just in the space of 5 years. So that's huge. That's a huge increase to your wealth if you are able to get over the hurdle of buying that first home and starting to build that equity. Okay, so why is it that house prices are anticipated to continue to grow? I mentioned before about supply and demand. If you look at this chart here, we can see the blue columns are household growth and the orange columns are annual completions. So think of the blue as the demand. Each household needs a house to contain it. And the orange is the supply. These are the new houses that are being completed and made available for purchase on the market. So if you look at the tail end of this chart, you'll see that we've had a steady, slightly increasing amount of household growth, but significantly lower annual completions. So in answer to the question, is this like 2008? Are we in a bubble? Are home prices going to go down? Supply and demand suggests otherwise. In fact, what we're expecting is that all of the people who've been sidelined now because of the increase in interest rates are waiting for those interest rates to come down, and they're going to jump back in the market all at once. And if you can't get out ahead of that, you're going to be back in a situation where you're competing with multiple offers, maybe even having to offer above asking price in order to just be able to buy any home at all, let alone get into the one of your dreams. All right. What else do we have as data supporting the increase in the value of our homes? Remember, more people, more households, more demand, higher home prices. Looking at this next chart, the US Census Bureau says population growth is ahead of us. So we're looking at the number of US births by year and generation. So we have the millennial generation, 66 million births, and the post-millennial generation, 61 million births. And we are slowly getting to the point where the post-millennial generation is reaching adulthood and starting to think about purchasing homes. So we're expecting them to enter the market. And so over the long term, of course, we're expecting increase in the demand for homes. All right, so what has the press been saying about the housing market, and should we trust them? Right now, they're saying panic, step back, don't buy. But in the past, when they've said this, have they been right? Should we have trusted them? Let's look at some historical examples. In October of 2015, Housing Today said a bubble larger than 2006. In 2015, there was appreciation of 5.1%. So if you had bought a house for $300,000, that value would have increased to $315,000. Next year, August of 2016, we're in a new housing bubble. Appreciation that year was 5.4%. That was an increase of $17,000 in the equity of your home. So your home price would have gone from $300,000 now all the way up to $332,000. November of 2017, home ownership doesn't build wealth, study finds. Well, in that year, that same house would have built $20,000 of wealth. Now that's appreciation. That's not the equity gained from paying down the principal on your mortgage. That's pure gain to you simply by occupying and owning that home. 2018, it's better to rent than to buy in today's housing market. In that year, appreciation was 4.1%, adding another $14,000 to the equity of that home. July 2019, the housing market is about to shift in a bad way for buyers. Well, that kind of turned out to be true, but that was because of the pandemic. Nobody could have predicted that. What happened that year? 4% appreciation, $15,000 growth in equity. December 2019, next year will be hard on the housing market, especially in these big cities. Well, they were right, but again, not for the reason that they thought they were. It was hard because everybody wanted to buy because home prices were skyrocketing. 16% appreciation. So if you had listened to the media back in 2015, 16, 17, 18, early 2019, and stayed out of the market, in that year, you would have passed up $61,000 growth in your wealth that you would have gotten just by continuing to occupy the home that you purchased. July 2021, housing boom is over as new home sales fall to pandemic low. Well, in 2021, record high appreciation, 18% for a whopping $80,000 growth in your wealth. So this home back in 2015 that you could have bought for $300,000 in the space of 6 short years has increased in its value to $523,000. That's over $500,000 in a very, very short space of time. So what I want you to take away from this slide here, the media loves to stir up fear. But home values over 60 years, and that just happens to be as far back as my data exists, they've continued to grow steadily over time. It has been over and again the best investment that most people are able to make in building their wealth over time. And of course, you get all the benefits of home ownership, the security, and another benefit that doesn't get talked about a lot is mortgages don't go up over time. Rent does. Okay, so before we talk about rent, let's talk real quick about affordability. Homes are still affordable compared to income. So I got a lot of numbers going on the slide over here, but I just want you to focus on a couple of them. In 2021, typical loan amount of $400,000 experienced 15% appreciation like we just saw in the last slide. So that goes up to $460,000 in 2022. Household income averaged $9,000 in 2021, experienced a 9% increase for an additional $810 a month. Now, if you look over here on the side, I've got a little note. I've got stayers and I've got switchers. If you stayed in your job, your income growth was 7.7% on average, right? Obviously, some got more, some got less. If you switched positions, your average increase in income was 15.2%, perfectly matching the increase in prices of homes. You average those together and you get 9%. Looking forward to 2023, we're anticipating household income of $10,565 if these trends continue, which is more than enough to continue to afford home prices at the rates that they're growing. All right, so generally speaking, does it make sense to buy a house? Is this a good way to build wealth? Is this a good investment? So looking at the slide I have here of net worth tiers, the top 1% of households have $10.8 million in wealth. If you go down to the top 50%, we're looking at $500,000 in wealth. On average, 2/3 of a family's net worth comes from their home equity. So these are really big numbers. So is it a good idea to build wealth with your home? Absolutely. 2/3 of $500,000, even for the bottom 50%, is still a large chunk of money. All right, so now let's talk about rent. Everybody needs a home. So regardless of if homes are expensive, or some people say they're overpriced or they're overvalued, regardless of what you think about what's going on with the real estate market right now, everybody needs to live somewhere. So if you're not going to live in a home that you own, you have to live in a home that you rent. So the real comparison when you're trying to decide is now a good time to buy a home is, well, do you own a home already? Because if you don't, you're going to be paying rent. And as I mentioned earlier, rent tends to increase over time. It doesn't tend to go down. So let's look at an example. So let's suppose I were to buy a house at typical home prices for a monthly mortgage at current rates of $2,517. My rent, again, this is average, typical for the area, for an equivalent home, $2,750 in the first year. But with an annual rental increase of 6%, after 9 years, we're looking at $4,383 a month to rent that same home. But what does your mortgage do over the course of 9 years? If you got yourself a fixed rate mortgage, it doesn't do anything. It stays the same. Now, property taxes could go up, your home insurance could go up, but that's a very small percentage of your overall housing cost. So, in 9 years of renting, you're paying over $4,000. If you had bought that home today, you'd still be paying $2,500 a month. If you look at the effects on your wealth over that same time period, the expected appreciation gain on that home is $193,926, almost $200,000 just for living in your home. In addition, I have over here the amortization gain of $41,034. This is the gain that you're getting because a mortgage payment adds equity. You're paying down the principal balance of your loan. If you sit in that house for the full term of the loan, whether it's 15 years, 20 years, or 30 years, then at the end of paying every single one of those mortgage payments, you own a house free and clear, and you never have to pay a mortgage or rent ever again. But if you pay rent for 9, 10, 15, 20, 30 years, at the end of that time period, what do you have? You don't have anything. You have a long history of making rental payments. So over the course of 9 years, what are we looking at? 41,000 plus 193,000. That's about 235, give or take a couple grand in there, $1,000 benefit that you got just for making that housing expense be a mortgage payment instead of a rental payment. So one of the phrases that, we in the mortgage industry have been throwing around right now is, what are we recommending to you? Divorce the rent. Don't stay with that. That's not doing anything for you. Marry the house. Find a house that you love. Find a house that you want to live in long term, and then date the rate. So what does that mean to date the rate? It means it doesn't have to be a long-term relationship. So let's talk about how today's relatively high mortgage rates don't have to be a permanent thorn in your side over the long term. Okay. Right now at Churchill Mortgage, we're offering a rate relief program, sometimes referred to as a 2-1 buy down. And what this is allowing you to do is get last year's mortgage rates, or at least the payment that would be the equivalent of last year's mortgage rates in today's market. So here I have an example of a $500,000 home. This is a $400,000 loan amount. In these 3 columns, I have an example of what the 2-1 buy down strategy looks like. This third column is called year 3, and this is what your mortgage payment would be at today's rates. So today's rates, 7.5%, give or take a little bit. They're a little bit improved compared to when I made up this slide, so it's not quite that expensive. But this home purchase would be $3,359 a month. With the 2-1 buy down strategy, what you're able to do is pay the equivalent mortgage of $2,833 in the first month. So that is the payment that you would have if you were getting a mortgage rate of 5.5% instead of 7.5%. In the second year, we're going to step you up by 1%. So now your payment is going to be $3,090. And then in the third year, we step you up the final percent to whatever today's market rates are. But here's the thing. Why is this such a cool strategy? It's a cool strategy because, as I mentioned at the beginning of this talk, we're anticipating that mortgage rates are going to come down. We are heading into a recession, and recessions reliably bring mortgage rates down. So how do you divorce the rent, marry the house, and date the rate? You move out of your apartment, buy a home, utilize our rate relief 2-1 buy down strategy in order to keep those mortgage payments low at the start of your mortgage. And then when we head into 2023 and those rates start coming down, as they reliably do every time we head into a recession, you're going to refinance that mortgage and take advantage of the lower rate. So this $3,359 is really just a hypothetical. You may never get there. So that is my argument for why now is still, despite everything that's happened, despite all the fear mongering and the anxiety and the ups and the downs that have been going on in the market, that is my argument for why now is still a great time to buy a house. And moreover, it's not just a great time to buy a house, it's the best time to buy a house in the next 1, 2, 3, 4, 5 years. And that's because we're expecting that it's going to become more difficult heading into 2023 to buy that home, because we're seeing construction has already started to slow down in response to the decrease in demand that was a response to the increase in the interest rates. It takes a long time to build a house. Interest rates are going to come down a lot faster than supply can come back up again. That's going to create a backlog in the market. We're going to see a lot of demand. We're not going to see a lot of supply. And that's not a great environment to try and buy a house. So get out there, find the home of your dreams today. Talk to me about how to make that home affordable both today and in the long term. Because like I said, now is a great time to buy a house, and a house is a great way to build wealth. I'm Danny Cadambay. You can reach me at 615-767-5600. I would love to talk to you about how to make this possible for you. Thanks so much for listening.